There's a bank in your city right now that has $10 million in customer deposits and about $900,000 in actual cash. The rest? It doesn't exist. Not in a vault, not in an account somewhere else. It's just gone, lent out, spent, converted into numbers on a screen that represent money that isn't there. And this isn't a scandal. This is Tuesday. Welcome to the global financial system, where almost everything you think of as money is actually just a promise. A very confident, very fragile promise. Let's start with a question most people never ask. What is money? Not philosophically, practically. When you check your bank balance and see $5,000, what are you actually looking at? You're looking at a number, a database entry. Your bank is telling you that you own $5,000. But here's the thing, your bank doesn't have your $5,000. It has a fraction of it, maybe 500, maybe 250. The rest has been loaned out to someone buying a car, or a house, or starting a business. This is called fractional reserve banking, and it's not some fringe experimental policy. It's the foundation of every major economy on Earth. Here's how it works. You deposit $1,000. The bank is required to keep a small reserve, let's say 10%, so it holds on to $100 and loans out $900. That $900 gets deposited into another bank. That bank keeps $90 and loans out $810. Then that gets deposited and loaned and deposited and loaned. By the time the cycle completes, your original $1,000 has turned into about $10,000 of total money in the system. Except only $1,000 of it is real. The other $9,000 is just belief. Belief that everyone won't ask for their money at the same time. Because if they did, the whole thing collapses. Now let's zoom out. Because it's not just banks doing this. It's governments, corporations, entire countries. The United States, for example, has a national debt of about $36 trillion. That's money the government has borrowed and promised to pay back. But here's the uncomfortable part. It probably won't. Not in full, not in real terms. Instead, it'll print more money. Inflation will slowly erode the value of that debt. And the people who lent the money, mostly other countries and investment funds, will get paid back in dollars that are worth less than the dollars they originally lent. This isn't a scandal. This is monetary policy. And it gets weirder. Most government debt isn't owned by foreign enemies or shady oligarchs. It's owned by regular people, pension funds, retirement accounts, insurance companies. When you hear about the national debt, you're hearing about a promise the government made to you. But governments aren't the only ones playing this game. Corporations do it too. Take stock buybacks. A company borrows billions of dollars not to build factories or hire workers, but to buy its own stock. This pushes the stock price up. Executives get richer, shareholders get richer, and the company now has billions in debt. Is this sustainable? Only if the company keeps growing, only if interest rates stay low, only if nothing goes wrong. In 2019, American corporations had about $10 trillion in debt. By 2024, that number was over $13 trillion. And a lot of that debt is what's called investment grade, but barely. One downgrade away from junk status. The system runs on promises, but promises require trust, and trust is fragile. Here's where it gets uncomfortable. Let's say you're a pension fund. You've promised retirees that they'll get a certain amount of money every month. To deliver on that promise, you need your investments to grow at about 7% a year. So you invest in stocks, bonds, real estate, private equity. You take on risk because you have to, because the promises you made require returns that safe investments can't deliver. Now multiply that across every pension fund, every insurance company, every retirement account on the planet. Trillions of dollars chasing returns, all at the same time. And here's the problem. The global economy doesn't grow at 7%. It grows at about 3, maybe 4 in a good year. So where does the extra return come from? It comes from leverage, from borrowing, from taking on more risk, from financial engineering that turns 3% growth into 7% returns on paper. But paper returns aren't real until you sell. And if everyone tries to sell at the same time, there's no one left to buy. This is what happened in 2008. Banks had made promises they couldn't keep. They'd lent money to people who couldn't pay it back. They'd bundled those loans into securities and sold them to investors who thought they were safe. And when the housing market collapsed, the promises collapsed with it. The government stepped in, printed money, bailed out the banks, propped up the markets, kept the system running. But the system didn't change. It just got bigger. Now let's talk about the most abstract, most critical, and most poorly understood part of the promise economy: derivatives. A derivative is a financial contract whose value is derived from something else: a stock, a commodity, an interest rate, a currency. Here's a simple example. An airline wants to protect itself from rising fuel costs, so it enters into a contract with a bank. The contract says if oil prices go above a certain level, the bank pays the airline the difference. If oil stays low, the airline pays the bank a fee. This is called hedging, and in theory it makes sense. It reduces risk. But here's the problem. Derivatives aren't used for hedging anymore. They're used for speculation, for leverage, for making bets on bets on bets. And the numbers are staggering. The global derivatives market is worth about $600 trillion. That's not a typo, 600 trillion. For context, the entire global economy, every good and service produced on Earth in a year, is about 100 trillion. Most of these derivatives are fine, boring, balanced out by offsetting contracts. But some aren't. Some are concentrated, some are leveraged, some are tied to things that if they go wrong could trigger a chain reaction. And no one really knows where all the risk is, because derivatives are traded over the counter, privately between institutions. There's no central clearinghouse for a lot of them, no transparency. It's a web of promises, and if one strand breaks, the whole thing could unravel. So what happens when the system breaks, when the promises can't be kept? We've seen it before, in 2008, in the 1930s, in Argentina in 2001, in Greece in 2015. The pattern is always the same. Trust evaporates, banks stop lending, markets freeze, the government steps in. And the government has three options. 1. Let the system collapse, let banks fail, let companies go bankrupt, let the economy reset. This is painful, very painful. It causes mass unemployment, it wipes out savings, it destroys lives. But it clears out the bad debt and forces the system to rebuild on a more stable foundation. 2. Print money, bail out the banks, prop up the markets, keep the system running. This is what most governments do, because the alternative is politically unacceptable. But printing money has consequences: inflation, currency devaluation, and the creation of moral hazard where institutions take on more risk because they know they'll be rescued. 3. Some combination of both: a controlled collapse, a restructuring, a painful but manageable transition. But here's the thing. Each time the government steps in, the system gets more fragile, because the promises get bigger, the debt gets larger, the leverage increases, and eventually you reach a point where the government can't bail everyone out anymore, where printing money causes hyperinflation, where trust doesn't just crack, it shatters. We're not there yet, but we're closer than most people think. Let's zoom out one more time. The promise economy isn't inherently evil. It's not a scam. It's a system that, when it works, allows for incredible growth. It funds businesses. It builds infrastructure. It lets people buy homes and start companies and retire with dignity. But it only works if everyone believes it will work. If everyone trusts that the promises will be kept, that the bank has your money, that the government will pay its debts, that the stock you own has value. And belief is a funny thing. It's contagious, it spreads, but it's also brittle. Once it breaks, it's almost impossible to restore. Right now, the world is running on more promises than ever before. More debt, more leverage, more derivatives, more complexity. And the cracks are starting to show.
Inflation is back. Interest rates are rising. Debt levels are unsustainable. The gap between what's been promised and what can actually be delivered is growing. Most people don't see it. They check their bank balance and see numbers. They look at their retirement account and see growth. They trust the system because the system has always worked. But systems don't fail slowly. They fail suddenly. And when they do, the promises don't just break, they evaporate. So here's the question no one wants to ask. What happens when the world realizes it's been living on promises it can't keep? Maybe nothing. Maybe the system adapts.